If I can borrow cheaper from a bank, why not just do that? This is question number 6 in our 10 direct answers IBC to IBC questions series. And the main question that we're posing here is why not just use a home equity line of credit or a HELOC? Well, the first thing I want to talk about here is control. So, who's ultimately in control in a home equity line of credit situation? First and foremost, you have to have the equity built up in your home. Uh, some people have that, some people don't. Two, how much of that equity you can tap is ultimately up to the bank. So you have to go to a financial institution and you have to get an appraisal done. They have to review your financials. You have to go through all these hoops, so to speak, to see if that capability is available to you. And I've run into a number of different people in the past that even though they technically have enough equity, they are unable to use a HELOC because for some reason the bank's unwilling to do that for them. Now, again, this isn't about bashing on banks or anything like that at all, but it comes down to that control aspect. Who's really in control? Well, in that case, it's not you, it's actually the bank. They're the ones determining whether or not you can access the equity in your home. So there's definitely some differences then when it comes to home equity lines of credit versus policy loans. When we talk about a policy loan, you're the one who's in control. There are no extra hoops you have to jump through. You simply contact the insurance company and you let them know, hey, I need to take a policy loan. A lot of times you can do this simply through an online portal, and you'll be able to just request a loan amount, and it's going to show up within 3 to 5 business days into your account that you've already chosen to do that with. Once that loan is open, that loan is up to you. You set the terms. You determine when and how often those payments are going to be made or repaid back into the policy. And just like a home equity line of credit, once you pay that money back in, it becomes available to you again, so you can continue to use that account. At the same time, when you are making any interest payments, you're going with a bank, those interest payments are going out of your system forever. They are going to a banking institution. That's one of the ways that they're able to profit. With a mutual insurance company, when you are taking a policy loan, making a repayment and paying interest over time, while that structure, that repayment structure is fundamentally different in how it works, where you typically are going to end up paying lower interest because the repayment is going to principal first, as opposed to being split up between principal and interest. Separate topic. However, the control aspect of that and the value in that is it's going back to a company that you are part owner of. You've paid a significant amount of interest over time out of that's left your hands forever. Whereas if you are repaying policy loans, it's going back into a system you own and control. And any interest payments are actually going to a company that you are part owner of. And that increases or adds to the profitability of that company. And that can actually kick back to you in an indirect way through the form of dividends. The last aspect of control is with a home equity line of credit, the bank can call the loan. They can call that due at any time. With a policy loan, that's simply not going to happen. The collateral for that loan is your policy. So there's no one who's going to call and say, hey, you know what, we think that there's risk here and we want to call this loan, you need to repay it. With a home equity line of credit, that can actually happen. However, with a policy loan, that's not going to happen. The last part is who's going to win in the long term. Typically in a home equity line of credit situation, the bank wins in the long term. You are going to be much better off using your policy to finance a business venture, to identify some passive income opportunities, or maybe it's simply to purchase a new vehicle or whatever it may have. That's going to be a much better scenario for you in the long run. At the end of the day, the infinite banking concept is about owning that financing aspect of our lives. It's about controlling where money flows and benefiting from that in the long run. So utilizing your policy instead of a home equity line of credit is going to be a much safer, much more long-term oriented way to control your financing over the course of your lifetime.